Welcome to the show this week. We have a phenomenal show lined up for you. We're going to start off talking about capital gains. What is that? And then what does that mean for you, maybe your retirement and your future? Then what are 1031 exchanges? Do I need one? Should I have one? Then dive into sequence of returns risk, how that may affect the longevity of your income plan. Finally, wrapping up the show, we're going to do a deep dive into variable annuity fees. If you have a variable annuity or if you're considering one, you're not going to want to miss this. Stay tuned for much this and much more.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
I'm going to be talking about capital gains. And some people kind of grumble a little bit because guess what? Typically capital gains often generate taxes. I remind you, to my knowledge yet, there's no tax rate greater than 100%. So capital gains are still a good thing, right? It means you're making money. So what is a capital gain? Simply put, I bought something here and I'm selling it for greater, right? I have a gain in that. So buy low, sell high creates a capital gain. So what types of things can have capital gains? Obviously stocks, right? Investments, that sort of stuff. What about property? Maybe possessions of some sort. Now you have these cryptocurrencies coming out, right? Basically anything that can appreciate in value where you have a gain from your original purchase, right? Then there's two differences. We have short-term and long-term capital gains. Short-term, simply anything held, owned, less than 1 year. Long-term, anything longer, right? And the reason why that they separate those two is they're treated differently for tax purposes. Currently, under current tax law, short-term capital gains are basically taxed as ordinary income. It was just like you had extra wages or something like that. It's income. Long-term capital gains are taxed at the capital gains rate dependent upon your income level. So in some cases, it can be favorably treated. And if you have higher incomes, your capital gains rates may go up a little bit under current tax laws. So once again, important to know what two you have, or maybe there's an argument that you may want to hold that longer to fall into that category depending upon your tax situation. Remember, you can offset capital gains with capital losses. So the idea, I bought high and sold low there, right? I had a capital loss, that can offset capital gains. And so why could that be important? We talk a lot about tax planning on the show and mainly focus, it seems like a lot on Roth IRAs or Roth conversions, paying taxes on those 401ks and IRAs. What about these non-qualified accounts that are producing these capital gains? They call that tax harvesting. And that's something that a lot of times at the end of each year you want to be looking at. Do I have a large unrealized capital gain? And I'll get to unrealized in a second. But a large unrealized capital gain, maybe I want to look at realizing that years because I'm in a certain tax situation. So once again, plan for taxes, and even in these non-qualified non-IRA accounts. I mentioned unrealized. Basically, you haven't sold it yet. You have something you bought low, it's appreciated in value, and now it's worth more, but you haven't sold it. You haven't realized those gains yet, so therefore you don't have taxes owed yet. So that would be those positions that potentially consider tax harvesting. Inheriting something with capital gains. Boy, that could be tricky, right? Right now under current tax law, there's some favorable things with step up in benefits, step up in capital gains, so you may be a better tax situation, but be cautious, that may be changing and something to be keeping an eye on. Remember, IRAs don't have capital gains because you're deferring the growth, and when you take out of your IRA, it's all considered income. Hope that was valuable, folks. If you have accounts like this, give us a call. We'd love to walk through and see if there's strategies that may be able to put you in a better position so you can keep more in your pocket.
The stock market has a natural life cycle that is destined to encounter peaks and valleys. Those scenarios are frequently preceded by events such as changes in interest rates, new international trade negotiations, treaties, and tariffs, fluctuating levels in the national debt, global events that threaten the economic stability, Political controversies that impact national policies, dramatic news headlines that shape investor sentiment. While each of these issues, and certainly all of them combined, generate cause for concern, it's important to remember that we have been in similar circumstances before. One way to help gauge market-related anxiety is to consider observations made by renowned investment experts who have weathered many markets' ups and downs over the years. Contact us today for a complimentary portfolio risk assessment. We'd love the opportunity to help you plan to retire well. (1031) exchanges, what exactly does that mean? So this comes from IRS section 1031, and there's multiple parts for real estate investors who want to essentially defer paying their capital gains taxes by maybe swapping one investment property to another. So the primary advantage again of doing this is that deferral of the capital gains tax when selling an investment, instead of just realizing those gains and paying the taxes. Instead, you're shifting that property over to another property and deferring those gains. So let's use an example. Let's say 10 years ago you bought this investment property for $100,000, and here you are today selling that property for $200,000. So you bought it at $100,000 and you're selling it at $200,000. Now normally, if you just simply did that transaction, there would be $100,000 of capital gains tax that you would owe on the sale of that investment. So what a 1031 exchange allows you to do is instead identify another property where then you can just kick the can down the road by pushing that taxable gain over to another property. So the ideal scenario is one where you find another property owner that is wanting to sell their property and do exactly this 1031 exchange, but it doesn't always work out that way. And so that's where there's some different rules that apply to 1031 exchanges. For example, there's a 45-day rule where upon the sale of your property, you are going to identify a property that you want to purchase within 45 days, again, after the sale of your property. And you can maybe even go out and designate multiple properties, again, but there's rules that you need to follow within that. There's also a 180-day rule, so where you're essentially going to need to close on the new property within 180 days of the sale of your initial property. So to make this transaction happen, you need a qualified intermediary who holds the cash from this transaction. So that's an important piece, and if there's going to be cash left over from the purchase, then that's known as boot, or basically the intermediary will pay that money out to you as a taxable gain on the sale of your property, so you would have some capital gains in that situation. So again, 1031 exchanges can be a savvy real estate investment move that you may desire if you look to defer capital gains. But again, you want to look into all the specifics of this and make sure that you're following all those different rules of the 1031 exchange.
Welcome back. What a hot topic there, it seems like, as of late, is capital gains. I've been getting a lot of calls here recently as far as how cryptocurrency sales are taxed. And it is capital gains, okay? That is how it works. Recent scenario where a client way back when bought some Bitcoin, and he didn't spend much on that Bitcoin, and now it's worth a lot of money, and he wanted to get out of that, but he wasn't really sure what his tax consequences were. Once he figured out that he had some substantial capital gains involved, we decided to kind of sell those positions through a number of years instead of just liquidating the whole position in 1 year. And that can be the same case for any kind of non-qualified account that you have where you've held certain positions for years and years and years. It may be in your best interest to kind of slowly through the years whittle away at those positions where you sell them over time.
Absolutely. You know, Nick brings up a good point. We are getting questions all the time about what are the taxes on crypto? What are the taxes on a position that I've held for a long time in that non-qualified account? And that's why we get to help you understand what your options are. You know, we have an enrolled agent on our team, and he's a great resource for not only doing those complicated tax situations, he's a great resource to educate when and how we want to institute a really effective tax plan for you in your situation. You know, we just had a client who had a piece of property and enjoyed it, and it was good, and it was working, but then another piece of property, more land, more money, but he fell in love with that even more. And he wanted to go through and figure out how could he move from one property to the next without taking on all these gains in his first property. So he used a 1031 exchange. He jumped through all of the hoops, and he was able to get that prized hunting land that he had been looking for so many years without the tax bomb. And so if you have questions on your crypto, if you have questions on your taxable gains in your non-qualified accounts or with your 1031 exchange, please give us a call. No obligation, free consultation. We'd love to help you figure out what your options are.
Awesome, yeah. Stay tuned. Coming up next, we're going to talk about the sequence of returns.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Hi, welcome back. Listen, in this segment, I just want to have a little bit of fun because I want to talk to you about what they call sequence of returns. Now, there's a lot of financial jargon in our industry, you know, and you'll find that anytime we're talking about any kind of financial jargon, we want to give you a thorough understanding of what we're really talking about. Well, one of those things sometimes you'll hear people talk about is what they call sequence of returns. And the conversation I would like to have around this is, do you know that it doesn't matter the order of your returns, you're going to arrive at the same amount no matter what? And so I thought it'd be fun to kind of illustrate this on Chalk Talk to kind of give you a feel for what I'm talking about. So here's a person who has $100,000, all right, and they're going to get, in 4-year period, they're going to get an 18% return the first year, a 7% return the second year, a 12% return the third year, but then all of a sudden they're going to lose 40% in 1 year. Maybe this is like a 2008 or something. So you follow me on the math. The first year they make 18%, 18,000. They now have 118,000. Second year, 7%. They're now at 126. Third year, 12%. They're now at 141,000. And by the fourth year, now all of a sudden they lose 40% in 1 year, lose 56,000. But they're at 84,000. Now, what if I was to reverse that order? So the first year, instead of the last year losing 40%, what if they lost 40% right off the bat? And then in reverse, got 12% the second year, 7% the third year, 18% the fourth year. So let's look at that. How would that come out? Well, first year, I lost 40%. I'm down to $60,000. But now I start to build it back up. I get 12%, I get to 67.2. 7%, I'm now at 71,000. Now by the fourth year, 18%, guess where I'm at? $84,000, the same place. It didn't matter. Changing the frequency of the returns had no difference. Now, why is this important? It's just important to understand that, you know, that's the way the math is always going to work out. Now, some people, in fear that they're going to get a big negative, might want to take a little bit more risk on the normal because they think if I can just get some bigger returns in the early years, that'll make up maybe for that negative year. I'm just going to tell them, I'll talk to them about sequence of returns and say, listen, that the sequence of that doesn't matter whether you get the first year or the last year. The math is the same. So again, just thought I'd have a little bit of fun with you on that. Isn't it interesting that that's the result no matter what? So anyway, hope you found that valuable. Was a little fun. But if you want to know how maybe that affects you and your retirement and your planning, then give us a call.
Hey, welcome back. We hope that was a valuable little segment there for you. It's important to start to understand when you might enter your sequence of return risk years. I have a great acronym. Sorry. We don't want you to be sorry, which sequence of return risk years really start when you have to take your RMDs. Those RMDs at age 72 from those tax-deferred accounts set in place your sequence of return risk. And so that's why we want to understand how can we best position ourselves before those sorry years and during those sorry years. You might find that in one of those sorry years, let's say you're 75 and the government is making you take this money out of those tax deferred accounts, and let's say the market doesn't cooperate, the market goes south. You might find yourself saying, well, I don't want to sell at a big loss, this isn't good. Government says, all right, if you don't want to take your RMD, that's fine. We're just going to fine you 50% of what you're supposed to take out. So what do? You're gonna sell. You're gonna go take that money out. But that's why we get to do a lot of proactive planning. We get to set up a plan that says not only are we going to pre-plan for before age 72 with your RMDs and with your tax plan, we're going to continue that tax plan in the rest of your life. Every single year, we're going to be as tax efficient for you as possible.
Yeah, I think the key there is just planning, right? I mean, there are ways to minimize your RMD obligations come age 72. I mean, let's say you've got $500,000 in your IRA at age 72. I mean, RMD, you're going to be forced to draw almost 4% of that $500,000 a year for the rest of your life, and that does go up through the years. So that's north of $20,000 that you would be forced to take out come age 72. If we can do Roth conversions from the moment you retire until age 72 and maybe dwindle half of that away and put it away into a Roth account, that means instead of $20,000 a year, you're only forced to take out $10,000 a year. So, I mean, it's just so important that we get ahead of the game and we plan for that. Hopefully you found that valuable. Please stay tuned. We're going to be talking about variable annuity fees coming up next.
If you're retiring soon, it's likely you have many decisions ahead of you. One of the larger ones is Social Security. How are you going to take it? Are you going to take it early? Are you going to take it at your full retirement age, or maybe even delay it? Social Security needs to be viewed as an asset. If you live a long life, it's likely you can collect a large sum of money over time with those payments directed to you. How, though, folks misjudge Social Security commonly is how it's taxed. How are you going to pay tax on that for the rest of your life? And it's important to factor that in when to take it. And also paired with your other assets you may have, it may make great differences as well. If you don't have a Social Security tax plan built into your retirement, it's extremely important and could cost you thousands over your lifetime if done improperly. We would love to sit down with you here at Centennial Wealth Advisory and talk through what that looks like on a larger scale and see if we can help you have a successful retirement.
At Centennial Wealth Advisory, we take a holistic approach to your retirement planning. So it's not just looking at what your investments are, but what is that long-term income plan for the next 30, 40 years of your retirement? What about taxes and what role they play in your retirement plan? Estate planning, what about life insurance, health insurance planning, all key areas to consider when looking at your retirement. So please visit our website or call the number on the screen. We'd love the opportunity to sit down with you for a no-cost, no-obligation visit.
In CFP Talk this week, we are going to dive into all the fees that are associated with variable annuities. Now, before I do this, as you know, if you watch a show, you know that this is one of my big pet peeves. I mean, it drives me crazy how, the financial planning industry seems to be the only industry that works hard to hide what they're charging you. I mean, I love what we do. I think what we do is fantastic, but gosh darn it, why can't we be upfront with you when it comes to the fees? Why can't we be transparent? And variable annuities are one of the biggest, biggest challenges, I guess we could call it, in this environment. So let's go ahead and look at a typical variable annuity and all the fees that you're being charged. And guess what? You don't see any of them on a statement. None of these fees are seen on a statement. The only time you see them is if you open up and read the prospectus. So let's go ahead and dive in. With a variable annuity, the first thing that you will see in a prospectus is something called mortality and expense fees. Now, what is that? That is essentially how the insurance company is paid. So they are collecting fees. That's where they get paid. It's where they get the money to pay the advisor. Very typically, this is going to cost maybe somewhere about 1.35%. That's a pretty common number there. You might find that are 1.25%, some are 1.65%, so it does vary, but that's not too uncommon. They're collecting that every single year. Now, they'll tell you that there's a benefit for that fee. The benefit is right here, mortality. What they'll tell you is, they'll say, if you invest, as we have down here, $500,000, if the account goes down because of market performance and you die, your beneficiaries will get at least the $500,000 you put in. If it goes up in value, well, they'll get the higher number, of course, but if you die at the wrong time and your account is worth less than what you invested, you're going to at least get that. So they tell you that's a benefit of that fee. But the reality is that almost never happens. In the real world, that's where the insurance company makes money. It's where they get the money to pay the advisor. Next, we have mutual fund fees. In a variable annuity, you are holding a portfolio of mutual funds. Pretty standard for those to add up to about 1% a year. That's a pretty standard number. Now, again, maybe a little less, maybe a little more, depending on what you have. I'm just trying to give you a feel for what we're dealing with here. And then the next one, and this is an area where pretty much every variable annuity has something like this below. Because here's the thing, let's stop right here for just a minute. If you take these two numbers and you add them together, that's 2.35%. That's a lot of fees for just basically holding a mutual fund portfolio somewhere. I mean, who in the world would think it's a great idea to hold a mutual fund portfolio and pay 2.35% a year with no additional benefits? I mean, nobody would do that. But what's happening in today's world is you have income, and DB stands for death benefit riders. So there are riders. An income rider would be where a company says, look, you put in a certain amount of money, we will let you withdraw a percentage, say 5%. And you can pull that 5% every year for as long as you live. Even if you drive that number to zero, we'll still let you pull that 5% out every single year. That's an example of an income rider. A death benefit rider might be, we're willing to grow this number at a certain percent each year and pay that out as a minimum death benefit. And typically those riders, it's not uncommon for them to be maybe 0.75% or something close to that, sometimes a little more, sometimes a little less. Now, if you add all of this up, if I do my math correctly, that's about 3.1%, not one year, but every single year. If you have $500,000 in an account like that at 3.1%, we are talking $15,000 a year in fees. And gosh, if you have an account like that for 10 years, that's $150,000 plus of fees on your portfolio over a 10-year period. How are you supposed to make money when you're paying those kinds of fees? Now, by the way, if you're paying $15,000 and they're earning $50,000, that's fine. But let's be honest, that's not what's happening, is it? You're paying $15,000 and they're lucky to break even in this day and age. So it's important that you understand all the fees you're paying. In our belief system, these should all be transparent and laid out for you, not just when you invest, but every single year. Now, if you have questions about this or anything else we talk about, please either pick up the phone, give us a call, come visit, or visit our website.
Welcome back. Another great blast from the past there with Michael Reese on variable annuity fees. You know, here at Centennial Wealth Advisory, we don't really use variable annuities frequently, but what we do have is an awesome software program where if you do have a variable annuity and you want to understand what you're actually paying in fees, we can get behind those products and show you, hey, here's the expense ratio for this product. Here's the different fees associated with it and what it's actually costing you to have this instrument. And remember, all these different insurance products, they're just tools to accomplish certain goals. So if those fees are high and maybe they're not accomplishing the goals that you're after, maybe it's worth that second opinion to have us look at it and dive deep into it.
That's a great point. You know, I love that we get to continually offer opportunities to educate you, and that just carries right over into our office. Here's a couple examples. I had a client come in, they had a variable annuity that they started in 2005, and they showed me the account value and they said, we've really been disappointed with these results. So I started looking at how they were positioned and so forth and educating them on that part of their variable annuity. But then there was another part, one of the riders, these income riders that they had put in place, and that had contractually been growing for a long time. And I said, what is your goal with this variable annuity? And they said, you know, when we very first started this, it was for income. And so as soon as I was able to educate them and say, well, good news to you, that benefit base of that roll-up is really high. In fact, there's nothing around that could be better. You really shouldn't probably let this thing go. I understand the account value might not be where you want it, but the income that you can get from this product is still really strong. Next client comes in, had a variable annuity, started going through, you know, the purpose of what they were using that for. And as I started educating them, this was a situation where it did not line up. The income rider that they had on it, the fees that they were paying were not in line with what they were trying to accomplish. So we were able to educate them on what some of those alternatives were, and they were able to pick a product that was way more in line with their risk and fee comfort. And it worked out great for them. So if you have any questions about how you might be situated in a variable annuity or any annuity for that matter, give us a call. We'd love to educate you on what you have and what your options are.
All right, we'll tune in next week, same time, same channel, and we've got some more great information for you.